Well, our next speaker needs no introduction. I think he's speaking to a room full of big fans. His books include Tomorrow's Gold. He publishes a monthly newsletter entitled Gloom, Boom, and Doom. A report which captures pretty much the views of everybody in this room. He's received his PhD in economics, magna cum laude from the University of Zurich. He's worked around the world and member of Barron's Roundtable. Today, mirror, mirror on the wall, when is the next AIG to fall? Marc Faber.
Well, thank you very much for this very kind introduction, and thank you very much for the kind invitation by the Mises Institute to ship me from Hong Kong to New York and back. Of course, I'm also grateful to you for giving me the opportunity to share some of my views with you today. And I'm very happy to be in New York. After all, it's the city I started to work, because after studying, I didn't know what to do. But already then, Wall Street paid the highest salary, so I took a job on Wall Street with White Weld and Company. And then fortunately in 1973 they said to me, Mark, we want you to go to Asia and develop our business. So I played hard to get. And then they said, okay, what we'll do is we'll send you for 3 weeks to Asia, and then you come back and tell us whether you want to go or whether you want to stay here in New York and in Europe. So I went for a day to Tokyo and a day to Hong Kong and for 2 weeks to Pattaya. Pattaya is the capital of sin in the world. That has a very efficient and well-established service industry, in particular at night. So I said, yeah, I like it. So I stayed in Asia. That's the economic background I have. But I saw already then that Asia had some potential and so forth, and obviously what has happened in the world over the last 40 years is really mind-boggling. Just to consider that we didn't have Bloomberg machines, we didn't even have fax machines in the 1970s. Walmart had sales of 44 million and 24 stores and had just gone public in 1970. And Microsoft, Dell, Cisco, Google's, of course, didn't exist. So also in Asia, we still had Mao Zedong in China, the Cultural Revolution, and we were in the midst of the Vietnam War, and you couldn't invest in India and in China. Indonesia didn't have a stock market, and so forth and so on. So I would like to say is that basically, when people come to me and tell me, Mark, you've been so lucky to go to Asia in 1973 when there were so many opportunities, I think today there are far more opportunities than there were at that time around the world as a result of the breakdown of the socialist and communist ideology that has integrated 3 billion people into the market economy and the capitalistic system. But this is not what I'm here to talk about. Basically, 9 months ago, Mr. Krugman felt that the best would be to have another bubble, and that one could deal with the consequences of such a bubble at a later stage. The problem is that he already felt that way in 2001, and we know now what the consequences of that bubble were. In fact, what happened before 2001 and after is actually quite interesting from a monetary perspective. As you remember, in the late 1990s, we had a capital spending boom that was driven by the TMT sector, technology, media, telecommunication, and it led to a rise of 48% per annum for the Nasdaq between 1997 and March 2000, and the doubling of the Nasdaq between August 1999 and March 2000, but Mr. Greenspan couldn't see a bubble. And then after March 2000, when the Nasdaq began to collapse, the Federal Reserve, rightly or wrongly, became very concerned about a deflationary recession. So as you can see here, they slashed the Fed fund rate starting January 3rd, 2001, from 6.5% by year-end to 1.75%, and then down to 1%, and they left the Fed fund rate at 1% until June 2004. And thereafter, it is correct that they increased the Fed fund rate, but in baby steps from 1% in June 2004 to 5.25% in August 2006, and then they left it there. But as I shall explain, there was never any monetary tightening occurring in this period. And then the Federal Reserve and the Treasury, which kept on telling us that there wasn't a housing bubble and that the subprime problem was well contained, suddenly and surprisingly realized in September 2007 that the subprime sector was not an isolated sector in the US, but that the whole US economy was subprime. And then they slashed again the Fed fund rate from 5.25% to, as you know, at 0% at the present time. But I want to emphasize that this type of monetary policy, already expansionary before Y2K, leading to Y2K because of a misjudgment of the Fed, and thereafter the slash in interest rates after 2001 here, led obviously to credit expanding at a very rapid pace. And what a central bank cannot control when they drop their dollar bills into room is where the money will flow to, and 80% of the credit creation then flowed into the housing market, led to the housing bubble, and allowed essentially households to refinance their mortgages and use their homes like an ATM and then go and spend that money. So there we have already the impact of easy monetary policies on economic and financial volatility, which was felt before 2000, before March 2000, and thereafter in the housing industry. But I'd like to just focus on this period, September 18th, 2007, to the current time when the Fed slashed interest rates, because what then happened is actually quite interesting. And here I have to go back somewhat in history. Commodity prices, they move in very long-term cycles. As you know, they had kind of bottomed out, or the great Kondratiev cycle had bottomed out in the 1940s. And then commodity prices had a rising tendency, and the rise then accelerated in the 1970s, with oil going from $3 a barrel to close to $50 a barrel on the spot market, and gold from $35 to $850 in January 1980. And after January 80, commodity prices then were in a long-term bear market that lasted more than 20 years. And they bottomed out basically here in 1998 and again in 2001. And then this is the price of oil. Commodity prices started to rise, partly driven, of course, by the incremental demand from China, and also partly driven by the fact that as prices had gone down for 20 years, hardly any new investments in new production facilities and capacities had been undertaken. So prices went up, and then they peaked here in May 2006 with oil here at $75. Then oil prices fluctuated sideways around the $70–75 a barrel until here September 18th, 2007, when the Fed slashed interest rates. The CRB index and commodity prices went ballistic. Oil from $78 to, as you know, $147 in July 2008. But as you remember, officially, the US economy had begun to recover in November 2001, but then officially also it went into recession in November 2007. In other words, there was a slowdown in global demand for commodities in the second half of 2007 already, and certainly in the first half of 2008. So the only reason commodity prices went ballistic were the artificially low interest rates by the Federal Reserve that drove speculation. And the impact, and I always say monetary policies have frequently unintended consequences. One of them was obviously that the crude oil outlays, the expenditure for oil in the US, in other words, what the consumer pays for oil, went up very strongly. They had reached a low here of around $75 billion annually in 1998. That was what the US spends on oil. Then they had risen to $500 billion here in 2006. But when the Fed slashed interest rates to zero after September 18, 2007, the outlays doubled from $500 billion to close to $1 trillion. That was an additional tax on the consumer. I'm not saying this is the only reason that the consumer went into recession. But whereas the Fed tried to cushion the downturn with lower interest rates, the lower interest rates produced a tax increase in the order of $500 billion, which is quite substantial on a $14 trillion economy. So all I'm suggesting is that monetary policies and any intervention by the government into the economic system can have numerous unintended and frequently unforeseen consequences. I mean, you're all familiar with total credit as a percent of GDP.